They simply don't know. And nobody knows right now because it's really hard to read the tea leaves in this market. If I'm an opportunist, I might put on a position. But what I'm doing right now is I'm waiting. I'm waiting for the big event, as I call it. It'll be a day of panic. We'll be down somewhere between 2,000 and 3,000 points. And yeah, it's horrible to talk about it, but I haven't seen the downturn of the consumer yet. Generally, a bottom, and I've seen this movie so many times before, is you need a big institution to go bankrupt. That always helps. I mean, you have to sacrifice an institution to get this to work, because then you get a dramatic flushing of equity positions as panic sets in. Margin calls are called in, shorts, are bought. They basically bought themselves in already, and then you get this big leg down. Usually it's 5 to 10%, and that is the bottoming process we need. Now, this time I was thinking it might be in the crypto space, but that's already been decimated, and so it may be something else, a financial services company, or there was some rumors about Coinbase that turned out not to be true. But you need somebody's offside somewhere on a leveraged hedge position. You just don't know who it is yet, and they're big. And we're going to wake up in the next 10 days, 20 days, and you're going to find out they're a zero. That's a good thing. And I'm waiting for that to happen because we're getting close to a bottom here.
Okay, so when that happens, any feeling as to what company it could be, Kevin? What sector?
No, it's hard to say. No, we're having a garden variety correction. Valuations got stretched. There was tremendous liquidity in the market. You got to remember, prior to the pandemic PPP programs and all the support and printing $4.5 trillion, this was standard volatility. It wasn't uncommon to have the VIX past 30, and we forgot about it. A whole generation of investors forgot or never learned what volatility was. Well, welcome to volatility. And now it's affecting many different sectors with the exception of energy for obvious reasons, but each sector seems to get maligned every second week. And so the whole market's PE is being taken down with the uncertainty around inflation, Ukrainian war, and this has been talked about for weeks now, but there's no safety in saying I'm going to go high in Walmart, for example. You just lost 20% there. That's because the market's trying to figure out what comes next. It usually happens in financial services where somebody was trying some strategy, a leverage strategy. It's always leverage that does this, or a hedge fund. Hedge funds, a good hedge fund that loses 10 or 20 billion, that's also good for flushing. And that's happened many times before. These are guys that, have never seen this kind of a market, so they set up a position that went awry, couldn't unwind their leverage, and they just get wiped out. And again, I feel sorry for them, but I think it's very healthy when that happens. And the trouble with this correction is it's a slow grind down 1 to 3% a day. And you don't really bottom till you get that flush. Remember, you only have to go back to 2020, 2021, when the height of the pandemic was ripping through the economy and people had tremendous fear. And not only was the Fed, trying to be very accommodative, but we were also printing $4.5 trillion. And so it's not a big surprise that you would have inflation now. That's what happens when you run the printing presses. It's unprecedented to print that much money ever in the history of our economy. And so having some inflation. Now, the big question now is what portion of it is transitory? Let's take a hint from what happened with Target and Walmart. Half of their problems were supply chain issues, the wrong mix of product, and increased costs of transportation. So it wasn't that the consumer rolled over and didn't want to buy anything. That wasn't the issue. The issue was they really had increased costs. In the case of Target, an extra $1 billion+ in just transportation. And so that really is something that's transitory. That's not going to be around forever. So you have to kind of put that into the cake when you're talking about 6 to 8% inflation. Maybe 4 to 5% of that is real, and the rest of it is short term. And the market's kind of waiting to see which quarter we start to see that wane a bit, maybe come down to 7-6%. I mean, if you're a real pessimist, it's one more 50-bip hike and then you have to reverse course and take it back 90 days later. I don't think that's going to happen. The reason I say that is if you look at employment, we're at full employment right now. It's really hard to forecast a recession at full employment. And so we're in a really interesting situation here. For the real pessimists about the economy, they're saying, well, the consumer spent, they're about to roll over. But everybody I talk to that's selling to consumer, including the Target and the Walmart numbers, show that the consumer is still flush with cash. It takes a long time to spend $4.5 trillion. And so each recession is different. And this is a predictive correction in the market. We haven't actually had the bad news yet. We're just predicting it. So we're pulling down valuations and really rapidly across all sectors. There's nowhere really to be safe right now with the exception of energy, because energy prices continue to spike and the cash flows of oil companies that have fallen out of favor, and even the president didn't like pipelines, et cetera. Well, that turned out to have been a mistake. And now we have these exceptionally high $4.5 to $6 gallon prices, and consumers are not happy. Anybody that wants to make forecasts about when the start of a recession happens, they simply don't know. And nobody knows right now because it's really hard to read the tea leaves in this market. And so the question that everybody, including me, has every day when I see a correction like this, when I see Walmart down 20%, for example, which is a bellwether stock, if I'm an opportunist, I might put on a position. But what I'm doing right now is I'm waiting for the big event, as I call it. And you get these events, and we talked about it. That day will be an interesting day to put 1/3 of your positions on. It'll be a day of panic. We'll be down somewhere between 2,000 and 3,000 points. And yeah, it's horrible to talk about it, but that actually is very healthy, very, very healthy. You get the PE of the market down into the 15 range, even lower. That's a tremendous buying opportunity. And I actually think earnings are going to be pretty good into the first and second quarter next year because we're still at full employment. And so, all of these concerns and the Armageddon scenarios, and these are putting pressure and compressing PEs, but I haven't seen the downturn of the consumer yet. And so you need to kind of see that. Everybody's forecasting it, that's true, and pricing it into the stocks of consumer products and retailers like Walmart and Target, but they actually haven't seen it yet. I think what's happened is it's a safety trade. I mean, you've really got an unusual situation occurring in Europe with this unwinnable war. It seems it's going to grind out for years, potentially. And so obviously, when you think about that, people want to reallocate their currency. And right now, the US dollar is the safety trade. It is interesting to think about what that means because it should have shown up in a higher move in financials. JP Morgan would be a good example, yet the stock is down 20%. And so something's fishy, if you want to call it that. Strong dollar, higher rates, and financials turn down 20%. That's unusual. That's what I'm saying. This market is not yet finished trying to find its new equilibrium because nobody would have forecasted that. There were people just 8 weeks ago talking about loading up on financials and energy. Energy was right, financials was wrong. You basically made no money if you put those on equally. If you try and figure out the Fed's mandate and how they think before they make their moves, it's the definition of insanity because at the end of the day, inflation is their #1 mandate. But also, they know they have a delicate situation, try and attempt a soft landing. And what the Fed doesn't know and what every other investor doesn't know is how much of this inflation is real and how much is transitory. Remember, we've never had a global pandemic that's a rolling pandemic. Right now, if I were the Fed, I'd be looking at what's happening in China, which refuses to take Western vaccines and is constantly shutting down cities, millions of people locked in their homes. That is very unproductive. That damages supply chains. You heard it from the CEO of Target saying, this is killing us in terms of forecasting what we need into the back end of the year because our factories are shut down. And that's kind of unique to China. Most countries are willing to accept the abundance of Pfizer and Moderna vaccine, which actually works. The effectiveness of the Chinese vaccine, whatever that's called, is sort of 35%. So if you're only 35% effective, you're going to have rolling pandemics forever. And so I think this has got to get resolved. And I think the leadership of China is probably worried about these images of people throwing themselves out of windows and lowering their dogs by their tether, so that they can do their business on the ground 20 floors down. I mean, the whole thing is crazy. But that's something that's got to get resolved because that supply chain directly infects inflation in the US. Until we solve for that, we're going to keep having this spiking inflation. And I think that's something that may be out of US control.